The United Kingdom is one of the largest economies in the world today and was arguably the single country with the largest influence in bringing the world into the modern age as the forerunner of the Industrial Revolution. That makes the economic problems we are about to explore all the harder to hear, because the declining dominance of the UK economy, as well as the social, political, and financial problems that are coming with it, doesn't need to happen. When an economy is going well, it's easy to keep it going well. Its currency will be strong, people will want to invest in it, it can borrow at low rates, and it should foster political stability, which means economic plans can be made over decades and generations, rather than rapid election cycles. When an economy is stagnating, or worse still shrinking, then its currency becomes less desirable, borrowing money becomes harder, people will avoid investing in it, and policy decisions will be made by whoever can make the biggest promises to voters who want a way out of the economic mess. It's easy to see what kind of situation the UK is in today. The country is not nearly as globally influential as it once was, and its economy is becoming increasingly concentrated in a few industries that don't do a lot of good for the average Brit. The economy that led the way in the Industrial Revolution and kicked off the biggest economic boom in human history is today struggling with very real problems like poverty and drastic regional inequality. The biggest problem above all, though, is that it might not matter. The actual economic situation of the UK is, if anything, underreported, and that's because the country is quickly becoming a two-speed economy, with extreme wealth concentrated in London, inequality, and economic decline everywhere else. The two halves average out, but really, the standard of living of most participants in the UK is going backwards. If policymakers feel no pressure to reverse this trend, then it will likely continue, which will be great for everybody lucky enough to be employed in the global industries of London, all at the expense of everyone else in the country. It is, if nothing else, a really interesting case study into what defines economic success in the modern day. So, why, despite centuries of dominance, is the UK falling behind all of a sudden? Has the growth of London come at the expense of the rest of the country? And finally, is it going to be possible to reverse these problems now that they've taken hold? Managing the economy of a country and managing individual finances are very different propositions. A country can go into massive debt to fund investment into public services, and as long as they grow the economy overall, it's considered a good investment. But for individuals, you need to be thoughtful about where you put your money. And that's why we're partnering with this month alone, we've explored the economies of Italy and Greece, two other European economies that have been stagnant since the mid-2000s. And it's important to make a big disclaimer here that the UK is not in as bad a situation as these countries were. The UK has obviously had a long, slow decline from its peak as a world-dominating colonial power, but its economic problems as they exist today arguably started on the 16th of September in 1992, now affectionately known as Black Wednesday. Before this, the UK still had its problems, but it was still seen as one of the most stable and reliable economies in the world to handle trade, finance, and investment. The pound was still the world's second most used global currency, and it had the reputation for being, well, as sound as the pound. Old people might remember this saying, but it doesn't make much sense today. 2 years before this fateful day, the UK entered into an agreement known as the Exchange Rate Mechanism, or ERM. This was almost an early precursor to the euro. What this agreement did was link the major currencies in Europe together with a pre-agreed exchange rate range. If a country's exchange rate between another member country got too high or too low, the central banks of those two countries would need to intervene to get it back within the agreed-upon range. This was a very expensive process, and it meant that the central banks of all of the countries involved needed to keep a lot of reserves of all of the other countries involved to make sure they could buy or sell whatever currencies they needed to keep their own currency within an agreed-upon price range. Now, this whole thing, at least in theory, was not as stupid as it sounded. By controlling the varying exchange rates between the countries, it would make it a lot easier for businesses to trade and invest across borders without taking on exchange rate risk. If a French company invested in an Italian business and then it doubled in value, that would be great, but if the Italian lira halved in value in that time, then the French firm would be right back to where it started. The exchange rate mechanism made it so that this was theoretically not possible, which did provide a big boost to cross-border interactions between the major economies in Europe. The UK actually did not initially sign up to this scheme when it was first introduced by the European Economic Community, the forerunner to the European Union, in 1979. It took 11 years for the UK to join the agreement after political tensions within the country tossed up the benefits and risks of indirectly pegging their far more dominant global currency to the rest of Europe. 1990 was unfortunately not the ideal time to jump on board the ERM because it coincided with the collapse of the Soviet Union and the reunification of East and West Germany, which might seem completely unrelated, but let's explain. The East, which was the satellite state of the USSR, was far less economically developed than the West, and the new unified Germany had to find a way to lift millions of people out of absolute poverty, modernize massively outdated industries, and build out connective infrastructure, all without destroying the existing economy in the West, which by comparison was doing really well. Now, the reason this was important to the UK is because Germany decided the best way to do this would be to increase their interest rates so that foreign investors would be tempted to put money into Germany where they could make a good return, and then Germany could take some of this money and use it to make the investments it needed to get the East up to speed. This was an unconventional approach because normally when a government wants to stimulate the economy like this, they would lower interest rates instead of raising them, so that businesses and individuals could borrow more money to promote economic activity through spending and business operations. The reason Germany didn't do this, though, was because they were afraid of the potential for inflation if the economic shock of absorbing the East hurt production. Germany in the period between the First and Second World Wars suffered through terrible hyperinflation, which spread poverty throughout the country, and even 60 years later that memory had not been lost. The high interest rates in Germany did exactly what they were designed to do. They attracted investors from all over the world that wanted to keep their money as Deutschmarks because they could earn a much higher interest rate on it. This included investors from the UK who had a comparatively much lower interest rate. And since the values of these currencies were tied together with the ERM, there was theoretically no risk in having money saved in Germany. The UK was hurt by this in the short term, as was the rest of Europe, but it did something far more damaging than that in the long term for the country. It started to raise doubts over just how well-managed the United Kingdom really was. In the years since the country was one of the worst-hit economies by the GFC and was then collateral damage from the Eurozone crisis, it went through a very uncertain breakup with the EU and is now probably best known for its revolving door of prime ministers. Although as an Australian, I really can't say too much about that last one. The problem this has created is that now nobody has much certainty about the future of the UK, which means that it's risky to make investments or trade deals or really do anything with the country because it hasn't displayed the consistency that it was once famous for. Now, of course, it should hopefully go without saying that the UK is still far more stable than a country like Somalia, but it's all relative. The UK has become highly dependent on the financial industry above all else. This has been great for the City of London, where most of this business is conducted, but it hasn't done much good for the rest of the country. Unlike a financial center, such as New York, most of the money that flows into London isn't flowing into domestic companies and projects. Instead, it's going into opaque financial investments made all over the world on behalf of people that choose to do business in the city because of its willingness to look the other way rather than the markets it grants access to. London is still the second largest financial center in the world, but the type of finance being done here is in many ways doing more harm than good to the rest of the country.